If you've never done it before, investing in stocks can seem intimidating and overly complex. However, there's no reason to feel this way. You don't need to be the Wolf of Wall Street to buy stocks. And to help you get started, in today's video we are going to address 5 frequently asked questions about investing. Number 1, what investing in stock means. Number 2, what's the difference between stocks, mutual funds, and ETFs? Number 3, how much money do I need to get started? Number 4, what else do I need to get started? And number 5, what investment strategy is best for beginners? Ready? Let's start with question number 1. What investing in stock means. Companies issue shares to raise capital that can be used to operate their business and supporting the company's growth. On the other hand, when you buy the stock of a company, you're effectively buying an ownership share in that company. And the primary reason investors own stock is to earn a return on their investment. In fact, there are 2 main ways you can make money from investing: from stock price appreciation or from the payment of dividends. Stock price appreciation is simply an effect of supply and demand. If more people want to buy a stock than sell it, then its price goes up. At its fundamental level, this happens when the company's growth prospects and future earning potential increases. When the stock price goes up, you can then profit when you sell your shares, because you will sell them at a higher price than what you purchased them for. The other way you could make money through stocks is from its dividends. However, please note that not all stocks pay them. A dividend is part of the profit of a stock corporation that is paid out to shareholders, generally on a quarterly basis, providing them with a stream of income through the time that you own the stock. The more stocks you own, the higher the dividend payment. And now, let's move on. Question number 2. What's the difference between stocks, mutual funds, and ETFs? As you know by now, a stock represents a share of ownership in both a company and the income it produces. Individual stocks represent a great way to build wealth, but if you only own shares in a limited number of companies, you are exposed to the risk that the poor performance of a single stock will severely hurt the overall return of your investment. This can be mitigated through diversification. Diversification ultimately means not putting all your eggs in one basket. And that's where mutual funds and ETFs come into play. A mutual fund is a portfolio of diversified stocks owned by a pool of investors. When you invest in a mutual fund, you own a share of that fund and are entitled to a proportional share in the underlying basket of securities. Mutual funds are overseen by a fund manager, who controls when and what to buy or sell with all investors' money, in an attempt to outperform the general market. And at last, we have exchange-traded funds, also known as ETFs. Much like mutual funds, ETFs are a portfolio of stocks, so they will provide you the same benefits in terms of diversification. But unlike mutual funds, they are not actively managed. ETFs are designed to track certain market indexes, like the S&P 500, or even indexes based on industries or countries. Because they are passively managed, they are subject to lower costs than mutual funds, which is great. But for the same reason, ETFs won't allow you to outperform the market. So what should you choose between stocks, mutual funds, and ETFs? We'll get back to this question toward the end of this video. For now, let's go on with question number 3. How much money do I need to get started? Most people think it takes a lot of money to make money. However, this is not true anymore. In the past, stockbrokers charged commissions of several dollars every time you bought or sold stock, and that, of course, made it prohibitive to invest with less than hundreds or thousands of dollars. In recent years, instead, the internet has made things a lot easier. And today, there are increasing numbers of options that let you get started with as little as $1, while charging no trade commissions. So you can start with small amounts of money, and then increase as you get more comfortable with the process. Keep in mind that no amount is too little to get started. The key is that you stick with your investment plan and develop the habit of saving, so that you can regularly grow the capital invested. Given enough time, you will be surprised at the investment return you can generate through the power of compounding. As shown in our previous video, even investing just $44 per month can make you a millionaire by the age you retire if you start soon enough. If you haven't watched this video, you can find the link in the description down below. Question number 4. What else do you need to get started? When you want to buy stock in a company, you can't simply call them up and buy shares. You will need to have access to a stockbroker, and the best way is to open an online brokerage account. While this might sound complex, it's actually similar to opening a checking or savings account, and the process typically takes only a few minutes. These accounts are offered by companies such as TD Ameritrade, Fidelity, Charles Schwab, Robinhood, and many others. Now keep in mind that online brokers are discount brokers. They won't give you investment advice, but only focus on little more than the basic service of allowing you to buy or sell a stock or other type of investment with a few clicks. Because of the no-frills service, the majority of online stockbrokers have eliminated trading commissions, so most of them are on a level playing field as far as costs are concerned, and deciding which one to use comes down to differences in the overall trading experience. For example, some brokers offer customers a variety of educational tools, access to investment research, stocks or fund screeners, and other features that are especially useful for newer investors. Others offer the ability to trade on foreign stock exchanges. Many will let you try a demo version before committing any money. And if that's the case, it is always a good idea to try a few and check out the user-friendliness and functionality of the trading platform. Question number 5. What investment strategy should I follow? There is more than one way to invest in stocks, and the best investment strategy depends on your goals, risk appetite, and how actively involved you would like to be in managing your portfolio. Some investors want to take an active approach with frequent trades, and some prefer to set it and forget it. Having said that, there are 2 fundamental options. Number 1, invest in individual stocks. Number 2, invest in ETFs or mutual funds. Investing in individual stocks might be right for you if you enjoy researching companies and are looking for an above-average return on your investment, as picking a few stocks gives you the chance to hit a home run. For example, if you had invested $10,000 in Amazon back in 2001, then your investment would have grown to a staggering $2.7 million by the end of 2020. Amazing, right? However, remember one of the key rules of investing. The greater return you want, the more risk you'll usually have to accept. While finding the next Amazon sounds tempting, it is nearly impossible to do. For one company that experienced such growth rates, there are literally hundreds that go bust, and that would lead to the loss of your entire investment. This is why we heavily recommend that you focus on investing in exchange-traded funds, rather than individual stocks, at least at the beginning. As mentioned earlier in this video, ETFs track a stock index like the S&P 500, so while you'll never outperform the market by only investing in an index fund, you'll never underperform it either. And that's okay. Long-term success starts with learning how to keep the odds in your favor and manage risk. Over time, the S&P 500 has produced total returns of about 10% annualized, and performance like this are enough to make you build substantial wealth over time. The earlier you start, and the faster your capital will grow. For now, thanks for watching, and see you next time.